inflation report. That's all everyone was waiting. We had these crazy jobs reports. We had all these things, and all anyone cared about was this new inflation report. What was it going to show? Because that was going to dictate what the Fed was going to do. All of a sudden, the SVB thing happens, and the new inflation report comes out. And that morning, I saw a couple reports, but because this was one of the first times that the inflation report actually came in almost exactly as predicted, then it literally didn't even make the news by the afternoon.
Welcome to the Bar Down Investing Show. Here are your hosts, Kyle Wilson and Jay Scott.
Hey there, and welcome to another episode of the Bar Down Investing Show. I am your host, Kyle, more affectionately known as Ashley Wilson's husband. And once again, I'm with my workout buddy, Mr. Jay Scott. How's it going, Jay?
I am doing well. That's right. You were in town last week. We were going to record a live episode together or an in-person episode together, and we got so busy we didn't do that. But we did get a couple workouts in.
Yeah, well, we were busy recording drunk real estate episodes, so keep an eye out for those ones. And I called Jay my ice cream enabler. I think he took me to every single ice cream shop in the entire county. So I appreciate you taking care of me.
Yeah, you wouldn't know it by looking at each of us, but you're one of the few people that can eat more ice cream than I can, I think.
Yeah, well, and because as a result of that, we had to go on a diet. So Jay and I are now on a diet challenge. I even made him buy a Garmin watch so the two of us can creep each other out on the Garmin Connect app.
Yep, working on 20 pounds in the next 2 to 3 months. So
20 pounds.
Stay tuned for this to kind of get better.
Yeah, and if you don't hit it, he's got to buy me a new golf club. So I'm looking TaylorMade Stealth 2. Here I come. All right. Any wins or losses? Nothing. There was nothing interesting going on this week, right?
Well, it's funny because everybody's been talking about Silicon Valley Bank, the bank that collapsed a week or two ago, and I'm going to take a little bit of a loss there. Not that it ended up working out, but turns out that between friends of mine that own companies that bank there, and banks that are companies that I invest with, and companies that I'm an advisor to, I had exposure of about $80 million to SVB Bank. So in the worst case where depositors would have lost money, my friends would have lost money, companies I invested in would have lost money, companies I advised would have lost money. But luckily, and I'm sure we'll talk about this more later in the episode, luckily everybody was covered and there's not going to be any losses there. So didn't end up being a loss, but it could have been bad.
Yeah, as of right now, they're still trying to court buyers for the bank, so it doesn't look like they're going to have to liquidate, which would have been kind of worst case scenario. Liquidate, then maybe people will get 70 or 80 cents on the dollar back of their deposits. But it looks like they avoided that. I'll throw in one win. We talked about this before. For the first time ever, I bought a treasury bond, or a bunch
Just
of them.
one?
A bunch of, actually, so they're 1,000 each. You got to buy a minimum of $1,000. But I think I mentioned before, my daughters both have these custodial IRAs. So we go through this whole thing where we pay them $6,000 a year for their modeling. They do a lot of stuff with my wife's Instagram and other things. So they had these custodial IRA accounts that right now the only thing they can invest in is basically anything like the stock market or anything just through a TD Ameritrade account. And I wasn't feeling confident putting anything in the actual stock market right now. But then these treasuries just got so high, especially the 2 and 3 year. So I was debating between the 2 and 3 year what to do, and I'd never bought one before, so I had to go through the whole auction process. And eventually, I decided on the 3-year treasury that I was going to throw their money in. And I did that, and then literally 3 or 4 days later, the SVB thing happened, and the treasury went from 4.625, which I got the rate at, down to 3.7. So I'll take that as a huge win. It almost went down 1%, and I locked in the higher bond rate. So not very often I pull things off like that.
Yeah, so for anyone out there who didn't quite get what that means, basically you locked in a rate of 0.625%. So if you hold those bonds for the next 3 years, the government's just going to pay you 4.625% interest on that money for the next 3 years, no risk whatsoever. Well, I mean, hopefully no risk unless something happens to the government, but no risk whatsoever. But like we learned with SVB, when interest rates change, the value of bonds, if you choose to sell them, can go up and down. And the fact that interest rates have gone down or bond rates have gone down since you bought those, that's actually good. It means the value of the bond has gone up. So you could probably sell those bonds now for more than you bought them for.
Yeah, I already looked into it, but I'm gonna hold it for a little bit longer because where else am I gonna put it? I don't have anywhere else. What am I gonna put it in the bank?
I like the anti-SVB.
All right, scorecard. How we looking?
Scorecard. We hit 3,000 views on YouTube, and with this
Whoop.
amazing content here, how could we not have hit 3,000 views? So yeah, 3,000 downloads on YouTube, and I'm excited about that.
We're pushing that YouTube stuff. We got some making sure we get the good video of the drunk real estate. I was carrying around that whole the backpack full of all my stuff to everywhere we went, different bars and all over the state. So make sure we get that good video for the YouTube content. Okay.
Anybody that didn't watch last Thursday's episode, that was a drunk real estate with a couple great guys from Southwest Florida. So check that out if you haven't already.
Okay, next, rock updates. You watched the Grammys at all?
The Grammys or the Oscars?
Oh, sorry, the Oscars. Yeah, that's right. It was the Oscars last Sunday.
I knew that, but no, I did not watch them. I look at the results, but I don't actually bore myself with the actual show.
We didn't have a lot going on in our house, so my wife put it on, and I happened to walk in right at the exact time that The Rock was gracing us with his presence on the red carpet, and he was wearing what is known as a ballet pink Dolce & Gabbana suit and bright, shiny black shoes. And he looked delicious. It was great.
You were jealous, weren't you?
Oh, I was so jealous. I could never pull off something like that.
Don't give yourself some credit. Sure you could.
I'll try it once.
I'd like to see you try at least.
Yeah, exactly. Yeah, so you can laugh at me when I don't pull it off. Okay, headlines. As I said, there's nothing really going on this last week. Oh,
yeah,
wait.
Boring.
There was a couple major stories. So let's start with the fluffy stories before we get into the meat of them. The first story that I thought was super interesting is Fannie Mae released a report that they were looking at the possibility of bypassing title insurance on single family homes. Now, the point of this was they're trying to look at ways to reduce the cost of purchasing a home. They're seeing the cost of all these different fees and closing costs start to tick up, and they're exploring ways to make things more affordable for the average home buyer. But I don't know if cutting off title insurance as a requirement is really the way to go.
Here's what I want to know. Let's say the first time a home buyer buys a house, doesn't get title insurance because it's not required, and then there's some title issue that costs the homeowner tens of thousands, hundreds of thousands of dollars.
Or even to lose the house.
Or lose the house. Who gets the blame? I mean, do we blame it on Fannie Mae? Do we blame it on the title company? Do we blame it on the real estate agent? Do we blame it on, who do we blame it on? And ultimately, it's going to just be buyer beware, and homeowners are going to get screwed. And I don't like that. I kind of like the idea of protecting the buyers who, most of them probably aren't smart enough to even realize what title insurance is and why they need it. But if they do need it, it's really important.
We touched on this in a previous episode with blockchain technology and all those things. And eventually we shouldn't need title insurance because it should all just be readily available. You could follow the chain of title. You could see liens. You could see all that stuff. We shouldn't need it in this day and age, but I think we definitely do. There's been a few times you flipped quite a few houses. We didn't flip quite as many as you, and we had to cash in title insurance once, where they had to take care of something. I already think it's risky enough that most places don't require you to get a survey in order to buy a single family home. A lot of things pop up on that, so I don't think they should be be stretching it any further. So I thought that was an interesting headline. And one more fluffy headline is you wanted me to put this on here. I didn't know if it was worthwhile news, but apparently ChatGPT released their their fourth version.
Yeah. What do you mean you don't know if it should be on there? That's like the biggest news out there. It's the most exciting thing.
So would they go from
Yeah.
3.5 to 4? Like, and we're all of a sudden supposed to be crazy about this.
So yes, if you look at it in nominal terms, 3.5 to 4, it's only a half point increase. Not very interesting. But let's talk a little bit about what this means. ChatGPT 4, they basically they had to take the equivalent of the bar exam, like the exam you take to become a lawyer. And a lot of people consider that like the hardest exam out there for any professional position. And ChatGPT 4 taking that exam scored in what would have been like the top 10% of all people that take the bar. ChatGPT 4 would have gotten into a top 20 law school, close to getting into like a Harvard or a Yale law school. Compare that to 3.5. The 3.5 version was in the bottom 10%. Likewise,
Doesn't that just mean that it's getting fed better information? Is that really a huge change?
well, there's two things. One, it's getting fed better information, but for the most part, ChatGPT has all the information out there on the internet. What they're doing better is they're training the AI better. They're training the AI to take the information and to assimilate it and to synthesize it in ways that are better than the way they previously did. They're not giving it new data. I mean, it's for the most part all the same data, but we have a whole lot more queries from people that have been using it, and you can use those queries to actually make the engine better. And that's what they're doing. And they're training it, they're making it better. And we're going to see this in successive iterations. It's going to get better and better and better. And version 4 is so much better than version 3.5. And I have a feeling that all the complaints that we were seeing over the last couple months about putting in things like 2 plus 2 and it spitting out 5, that's going away. In fact, they had ChatGPT 4 take the math SAT. It scored a 700. So not perfect, but still better than I think the 500 that it scored a couple months ago.
I mean, chess AIs have been beating grandmasters for years now, though. Like, I don't know. I guess I don't see them taking tests as being that impressive. And have they started putting in newer data? It wasn't only up to 2021 last time they released it.
Yeah, I mean for the public version. So I'm quite certain they have newer and better data in the private versions, and I'm sure they'll have newer and better data in the versions that get released as part of Microsoft's Bing search engine because they invested $10 billion into it. So I maybe you're right, but I think you're misjudging, and I think you're going to be suitably surprised and impressed at what comes out of this technology over the next year or two. So
Not
stay
that I'm
tuned.
not already impressed. I just didn't the iteration from 3.5 to 4. That's what I was questioning. I do think it's going to revolutionize a lot of things. We were talking about, it can create a website that would take people days. It could create it in minutes now, and same thing with like writing spreadsheets, writing code and stuff. It's going to completely change things like that pretty quickly. Other industries maybe it'll take a little bit longer to adopt, but there are definitely some things that it'll help pretty quickly.
Yeah, I saw.
I'm going
I
to
saw.
push.
Okay, go.
All right,
Let's move on.
I was just going to push to move on because we've already spent enough time on the fluffy stuff. Because let's move right to issues, because there was two pretty major issues happened, which was kind of interesting. Because if you had asked me 2 weeks ago, what's the only headline news that's going to matter in 2 weeks, what would have I asked? What would have I answered?
You would have said the inflation report and whether there's a Fed rate increase.
Inflation report. That's all everyone was waiting. We had these crazy jobs reports. We had all these things, and all anyone cared about was this new inflation report. What was it going to show? Because that was going to dictate what the Fed was going to do. All of a sudden, the SVB thing happens, and the new inflation report comes out. And that morning, I saw a couple reports, but because this was one of the first times that the inflation report actually came in almost exactly as predicted, then it literally didn't even make the news by the afternoon. The next day, this is one day later, you have to actively search for anybody talking about an inflation report. So I thought we should probably talk about it, even though nobody else is.
Yeah, so basically, as you said, it came in basically where it was expected, so somewhere around 6% annual increase, depending on if you look at all items or if you look at core or the typical one. So 6% annual or 0.5% monthly. Sounds like a big number, especially after we had a couple months of down around 0.1%, 0.2% negative for a month. I think a lot of the last few months have gotten adjusted, though, up a little bit higher. But this was still a little bit higher than what we've seen over the last several months, other than January. And but I think it's real easy to take a negative view of that. If you look at it from the positive side, yeah, we're at 0.5%, 6% annualized. It's still a good bit lower than what we were seeing last January, February, March, April, May, June, July, or May, June. And so, I mean, I think things are still heading in the right direction. I think we got a little bit spoiled in the fall when we saw numbers drop like really low and go negative there for a month, and everybody's thinking, okay, inflation's over. And that was a surprise. I think what we've realized now is that we didn't get that surprise that inflation's over, but we are still on the same trajectory that we were hoping to be on 6 months ago. Basically, if 6 months ago we knew exactly where we are today, but we don't know what happens in between, we're probably pretty happy. It just so happened that we got some really good readings in between, and so we were hoping for better, and so I think that's kind of changed our perspective. Now, the big question is, how does that CPI report translate into next week's Fed meeting, or this week's? Actually, this is going to be released on Tuesday. The Fed is going to announce their rate hike tomorrow. How is this going to impact that?
Yeah, and just looking forward, still, if you dive into this report a little bit, obviously energy is still pretty volatile. It's all over the place from month to month. Food's been sticky high. I'm sure that's one of the major ones that everyone's going to notice, right? People are going out to eat. People are going to the grocery store. They're going to notice that that inflation's hit pretty hard in those things, and that's probably why people are saying, "Oh, this inflation's got to go." But the one thing that's still, I brought it up last time, that's still there is that shelter component, and that shelter component is still pretty high, and it's just not something we're seeing in the real world. And because of that delay factor, at some point, I feel like that's got to hit and that's got to come down. And since it's such a significant portion, it's about a third of the CPI. You think that's got to help from week to week. So, but you're right. Normally, this would be the only thing that mattered for the Fed meeting coming up this week. Normally, it would just be okay, the jobs report and then this, but obviously, a lot has happened. SVB, all those different things. Before the whole bank collapse happened, we were seeing a toss-up between 25 basis points, 50 basis points. That jobs report kind of bumped us up, and we were getting not close to. It was still favoring 25 basis points, but that 50 basis points was on the table. Now, since the SVP thing has happened, we're kind of more like a 60% chance of no rate hike as of this taping. Who knows what's going to happen in the next 6 days, but 60% chance of no rate hike and a 40% chance of a quarter basis hike. So that's a massive change.
Yeah, if you would have just looked at, let's ignore everything that happened with the banks over the last week and look at yesterday's or last week's CPI number coming in at 6%. It would have been, I think, obvious to a lot of people, and it was baked in the numbers, that there was almost a certainty that we were going to see a half-point rate hike. And so, yeah, now that we're seeing potentially a quarter-point rate hike or even more likely no rate hike at all, that tells us that some other things have happened. And you mentioned that the whole banking thing that's gone on has been a big component of that. So let's talk about that. So essentially what happened was Silicon Valley Bank, a big bank in California, collapsed a week or two ago. And the impetus for that collapse is that the bank had bought a whole bunch of bonds a couple years ago when essentially it got about $100 billion in deposits. This bank works with a lot of Silicon Valley companies. And so a couple years ago when all these tech companies were raising hundreds of millions of dollars, they were all putting their money into this bank. So the bank had $100 billion in cash back in 2020, 2021. Couldn't loan out that money fast enough. Didn't want to let it sit in cash, obviously. So what did it do? It went out and bought treasury bonds, long-term treasury bonds. In
Which you'd think would
retrospect,
be that you'd think that would be a safe play, right? It's not investing in risky assets. It's basically the safest asset you can invest in.
absolutely. And we talked earlier on the show about if you buy bonds and you just hold them until they mature, if you hold them for the full span of the bond, you just get paid interest every month and there's zero risk whatsoever. And so they bought these 10-year bonds that if they were just going to hold them for 10 years, zero risk. They were going to get their 1.6, 1.7% that they bought the bonds at. Problem is, they got into a situation where they needed cash. So, as we all know, 2022 interest rates start going up, and venture capitalists and tech companies stop doing as much business. So companies aren't raising hundreds of millions of dollars. So this bank isn't getting hundreds of millions of dollars per month or per year in deposits. And so when companies start withdrawing money from the bank needs money. They need to get it from somewhere. They're not getting it from new deposits. So what do? They say, hey, we've got all of these bonds that we bought a couple of years ago, $100 billion in bonds. Let's sell some of them so we have cash. Problem is, just like we were talking about earlier, when interest rates change, the value of bonds change. In this case, interest rates have gone up significantly since they bought the bond, which means the value of the bond has gone down. The bank sold a couple $1 billion in bonds last week or 2 weeks ago when the bank collapsed. And what happened was when they sold those bonds, they took a big loss. And they had to report that loss to regulators. And regulators came in and basically said, hey, you don't have enough cash right now. You need to raise some cash. So they tried to raise some money from investors. They weren't able to do that. Long story short, they had to basically tell the public, hey, we bought all these bonds. We have a big, what's called unrealized loss. We haven't sold them yet, so we haven't actually lost the money. But we have the potential of losing a bunch of money if we ever have to sell these bonds. We sold some that lost money, and that just panicked everybody that was deposited in that bank. And so lots of these big companies said, oh no, I'm worried that the bank's going to become insolvent, that's going to go out of business. So they started taking their money out. And one day, 2 weeks ago, Wednesday, 2 weeks ago, the day before the bank technically collapsed or got shut down, $42 billion was taken out of that bank. And the bank couldn't absorb that type of withdrawal volume. And so regulators came in and said, we're shutting you down. And so that's when they got shut down. And so in some respects, you can say that the fact that interest rates went up so significantly over the last couple of years led to this bank collapsing. Now, there are a lot of steps in between, but there are a whole bunch of people who look at what the Fed did the last couple of years and they say the Fed raising rates caused this bank to collapse. When that story gets out there, everybody's now looking at the Fed and saying, hey, you got to stop raising rates because you're starting to destroy the banking system. Again, lots of other steps in between there that I don't think it was the Fed's fault. But still, the perspective right now is the Fed needs to slow down on the rate hikes because they're causing all these unintended consequences. They're causing all these bad things happening in the economy. And so I think it's likely that the Fed is going to take this seriously, this perception seriously. And next week, when they otherwise would have raised rates, they're going to say, okay, we're going to have to slow down now because we don't want to scare people into thinking we're going to break the economy even more.
I mean, giving the Fed a complete pass, saying it's not their fault. I don't know about that. But the good thing is that it doesn't seem like it's going to happen again to many other banks. Now, right away, there were a couple banks that were pretty teetering, and they had to close another one, and so. But it looks like there is no contagion to speak of. Everybody who's worried, oh, is this going to happen to my bank? First of all, if you're in one of those the big banks over 250 billion. Then there's much stricter regulations on those banks. There's what happened here could never happen to those banks. Second, for the banks that are still under that 250 billion that this could happen to, that have looser restrictions, then the Fed has already set it in measures of basically, hey, we're not going to force you to sell these treasuries to shore up liquidity. They're basically opening the discount window again, and they're saying, hey, you could pledge those securities and we will give you a loan to shore up your liquidity. So much so that I believe last time in 2008, that discount window of banks going to the discount window was like a sign of there was something going wrong at the bank. So the bank actually made everybody take money from the discount window. So there was no bad stigma about people taking money from that discount window. So just so everyone's at ease, everything should be fine at this point as far as that specific problem. But the point is that when you do something this drastic and raise interest rates at this crazy pace, you're going to break something. And people have been saying it since the beginning. Something is going to break. And this is just something that broke. Whether this is the only thing that breaks, who knows? Maybe the Fed will get the memo and be like, hey, maybe 5% is enough. We've already started breaking shit. Let's just pause and wait to see if we've broken anything else before we keep going. I don't know if they're going to do that. We'll see. But it's the same thing I was saying to you earlier, Jay, offline, where it was like people like to shit on the whole inverted yield curve as like, oh, what's that really a predictor of? How are we taking this as gospel that there's an inversion, so we have a recession coming? And it's not necessarily saying, okay, this directly reflects GDP or anything like that, but it's basically saying when these two things get so out of whack, something's going to break. And within that time frame of the 12 to 18 months, something typically breaks. And this is just what happens. So when they broke something. So I hope I assume everyone's going to get their money back at this point. They haven't arranged a sale, but I assume everyone who is a depositor is going to get their money back. I feel bad for the people at SVB because honestly, the Fed stepped in and they fixed the problem after SVB failed. So basically, SVB is just like the patsy that, oh, well, we realized that this is a problem. We fixed it, but we're not bailing out any banks. Janet Yellen coming in. We're not bailing out banks. We're going to prevent every other bank. So I feel bad for them. But other than that, like if this is the thing that makes the Fed say, okay, maybe we're going to pause and maybe we're going to get, stop on this crusade where we are actively trying to create job losses in order to, prove something. Then I think this might be a good thing in the long run.
So I'm going to agree with the last part. I definitely think pausing is the right thing to do, but not because of what happened with the banks, not because of what happened with bonds. In fact, I'm going to be the contrarian here and say, I don't think the banks did anything or the Fed did anything wrong. Look, every time the government passes legislation, every time the government puts in regulation or takes out regulation, whatever it is, there's always going to be unintended consequences. There's always going to be things that happen that we can't predict. And to basically make decisions like the Fed makes, basically the Fed is chartered with protecting a $25 trillion economy. To make decisions based on edge cases and relatively small ripples, I think is a bad idea. Now, people look and say, what do you mean relatively small ripple? Like banks are failing. Well, let me put this into perspective. If you look at every bank in the country, and there's a lot of banks, there's like 4,000 banks, you look at every bank in the country, and the total amount of unrealized losses due to this exact issue, these bonds being worth less than when the banks bought them years ago, the total amount of unrealized losses across all 4,000 banks is $620 billion. So basically, if every single bank was forced to sell every single bond, and this is a ridiculous scenario because they're not, but let's pretend every single bank was forced to sell every single bond they're holding today for a loss, the banks would lose $620 billion. I'm not saying that's not a lot of money, but let's put that into perspective. What is $620 billion? That's half the military budget in a given year. It's 20% of the total GDP or national budget in a given year. It's literally 2% of the total volume of the economy. I mean, it's a relatively small amount. And again, I'm not saying $620 billion is nothing, but I don't think the Fed should be making policy decisions and making economic decisions based on an absolute worst case of a $600 billion loss. And in reality, that loss is not going to be $600 billion. In the worst case, we're probably looking at a few billion, 10 billion, 20 billion, even 50 billion, which again, Fed should not be making their decisions based
Well,
on.
what should they be making their decisions based on, though? Because I'm confused whenever I hear the Fed speak. In the beginning, when they started raising interest rates relatively slowly in the beginning, before they started doing those 50, 75 basis points per time, in the beginning, the rhetoric was, oh, this is going to take 12 months to even show up in the economy, this rate hike right now. So we got to be patient. But then all of a sudden we got to these rapid 75 basis rate hikes, and they were acting like they have to do this absolutely right now. We got to raise it right now, or everything it's going to be panic. So if you take their original, what they were saying and how long it's going to take, then those major rate hikes haven't even hit the economy yet. So if you take that into consideration and you say, "Oh, you don't think the Fed has done anything wrong?" To me, this has been all wrong. To me, they've gone way too fast. They've got way too high, way too fast, and it is crazy to think that things aren't going to start to break. And it's not that they should be changing based off of this one thing. They should be changing based off of saying, "Ooh, this is just the first thing that happened. We haven't even seen those major rate hikes hit the economy, and this is already happening. Maybe we should pause. Maybe we went a little bit too fast, too much. Let's pause and wait for some of these things to hit, and then we could decide, okay, do we have to hike more, or can we back off, or is something else going to break, and then at least they didn't go that extra, and they don't have to panic even more."
Yeah, I mean, you're not going to get me to defend the Fed. I mean, I'm not one of those people that thinks everything the government does is right and everything the Fed does is right. Certainly, just the opposite. But I don't think that the Fed has made horrible decisions this past year. Would we have done things differently if we were in charge and we had the benefit of hindsight? If we knew everything that happened, we don't. We didn't know what was going to happen.
You're literally the first person I've ever heard to say this right now, by the way.
I'll take that. I'm okay with that because I know we've sat down before each of these Fed meetings and we've said, what should the Fed do? And I think if you look back, I don't think they were that far off of what we were saying at the time. It's easy, again, to look back and say, hey, they should have done something different.
But why raise 75 basis points on those when they could have just raised another quarter? Keep going, quarter. Keep steadily going, because to their own admission, what they're doing hasn't even shown up yet. So why do these massive rate hikes when they were borderline saying, okay, inflation's probably peaking around right now?
Well, 2 months ago, we were talking about how inflation was gone, how we were like now tracking to less than the Fed target of 2% because we had multiple months of 0.1 and negative 0.1, and we're like, everything's under control. Now it's just a question of, is it going to come back? And how aggressive should the Fed be to keep inflation from coming back this summer? And I think last month's report and this month's report was kind of a wake-up call that things weren't actually fixed. But I remember 2 months ago us having this discussion, or maybe I've had this discussion with other people, where everybody was kind of like, oh, wow, looks like the Fed actually got this right. And so I don't know. I find it hard. I guess my point is I couldn't have done a better job. I'm not sure what I would have done differently. I think I probably would have hiked a little bit faster earlier and slower later. They went the opposite way, but again, I don't think the Fed recognized how bad inflation was going to be last summer and last spring. And I don't know. It's a hard problem to solve, but
I mean, let's be honest. It's an experiment. Like, they're experimenting right now. No, they've never raised rates this fast before. So this is an experiment. They don't know what the effects are going to be. And I just think they could have been a little bit more deliberate about it, instead of just waiting for, like, we're still at this point where we're right before a rate hike. We're waiting for a CPI that, okay, they've self-admitted that whatever we do now isn't going to show up for a year. How does that make sense? We're waiting for information right now to make a change that's not going to happen for a year,
I think
knowing
I
knowing that historically the time between the first hike and the first cut is less than 2 years. So we're making decisions now based off of that aren't going to trickle to a year, and the whole cycle is less than 2 years.
Yeah, I think I can sum it up with what we mentioned earlier. And I think this is the biggest problem with the Fed. I mentioned earlier that the Fed is concerned about perception, and the reason they'll probably not hike next week or tomorrow, based on when this comes out, the reason why they probably won't hike is because they're concerned that the perception would be bad. People are concerned about this whole banking situation. People are concerned about the bond situation, and so they're trying to assuage the average person out there that's freaking out about what's going on. And I think we've seen that a lot over the last year. We've seen the Fed kind of bow to, I don't want to say political pressure. I'm sure there's plenty of political pressure that they're bowing to, but media pressure and just the pressure of the general public who is basically saying, you got to do something. You got to do something. Oh, now you've done too much and got to do less, or you have to wait, or you have to keep going. I don't know. It just feels like every time we talk about the Fed doing something, it coincides with kind of public sentiment about what the Fed should be doing. And so if I have to blame them for anything, it's that they're not acting independently enough and doing what they think is in the best interest of the economy. They often bow too much to, again, I'm sure political pressure behind the scenes, but also media and public perception in front of the scenes, to basically make sure everybody is happy, or as many people are as happy with what they're doing as possible. And so if I had to blame them for anything, it would be kind of trying to keep too many people happy, because you're never going to make everybody happy.
Yeah, the media is also, we've been with Powell for a while now through this hiking cycle, and the media is starting to figure out kind of how Powell speaks and what Powell plans on doing. So it's kind of reactive too. So yes, the public is saying, oh, this is what should happen, but they're also basing that on what Powell has said in the past and what Powell has done in the past, just what they think should happen. If I'm being honest, as much as I would love no rate hike, because obviously that's great for our businesses and stuff, I almost wish that they do 25 basis, just because I don't want to see a no rate hike, and then I don't want to see the next time they turn around and then start going back up again. I'd rather them do 25, and then just the possibility of after that they could say, okay, now we're pausing, and that could be like them pausing. I feel like if they do nothing right now, then they're going to do nothing based off of everything that's going on right now, not because they believe that they're pausing. And what we really want is a pause. It doesn't, 25 basis points. What is that really going to change in the grand scheme of things? It's not changing much. What's changing is the pause. Suck that volatility out of the economy, and banks will open up a little bit more. Their lending and rates will go down and stuff like that. So I'm almost hoping for a 25 basis point, and then that says to me maybe we'll get a pause the one after.
Yeah, let me point out one final thing, because I don't want to belabor this, but this I think is important. We talk about interest rates going up, leading to the economy slowing down and inflation going away. It's not interest rates going up that changes the economy. I mean, it is, but there's a step in between. Interest rates going up change the way people act. And the way people act ultimately impacts the economy. When interest rates go up, people act differently. They spend less, they save more, and that slows down the economy. And so one thing we need to consider is that there are other ways to get people to act differently besides just increasing rates. And I think what we're seeing, or what we're going to see, is that scaring people with things like potential bank collapses is going to be enough to get people to act differently. I think there are enough people out there right now that saw what happened a week or two ago, and they're suddenly jarred into, okay, maybe the economy isn't as resilient as we thought. Maybe things aren't as good as we thought. And that's going to get people to start acting differently, regardless of whether we increase, decrease, or leave rates the same. And so I think part of the reason why it would be okay for the Fed not to raise rates tomorrow is simply because I think a lot of people are going to start acting differently, just as if rates were increased, just based on the fear that we've introduced in the market over the last couple of weeks. So I think from that perspective, this whole Silicon Valley Bank and Signature Bank and all the other issues that we've seen over the last couple of weeks is going to be good when it comes to slowing down the economy and helping inflation, regardless of whether we see a rate hike or not.
I think you have a lot more faith in the common man than I do. You've watched these massive swings in the stock market. It just seems like people have very short memories these days, where it'll go down and then just bump right back up at the first sign of good news. But who knows? We will see. We will live to see another week. Next week we will be getting the news of what happened right around the same time that we're going to be taping a new episode. So we won't have to wait very long. To-do list. We got anything going on for the to-do list?
So I will say that we recorded some awesome episodes of Drunk Real Estate last week when you were down in Florida with me, with a number of people down in Tampa and Sarasota. So again, one released last week, but keep your eyes peeled because over the next couple of months we're going to be releasing a whole bunch of new Drunk Real Estate episodes, and I know everybody loves those. We loved recording them, and just massive value provided by our guests.
Awesome. All right, let's wrap this up. How would you rate this show?
I thought this was a good one. We actually disagreed on some stuff for the first time, and yeah, I liked it. I'm going to
Publicly. We disagree quite a bit privately.
I'm going to give this one a 9.1.
Oh, I think that's Jerome Powell just coming in and boosting your rating because you're the first person to defend him in the last year. Yeah, I liked it. I think it went a little bit long though, so I'm gonna have to give it probably an 8.0.
Okay, I think I could have expected that from you.
All right, how you want to sign this off? Are you ready with a quote yet?
I don't have anything, so
nothing.
I'm throwing it back to you.
So I'm throwing out a brand new quote that I saw on Instagram. So this guy it was at RCM, and I was just randomly browsing through Instagram. And he threw up a quote, and he said, because it was about inflation, and he said, with inflation at 7.5%, you would lose half your money in 9 years. And then he continued, and he said, the only way to outperform that consistently that I have found is crypto. And it got me pausing and thinking. Then he said, just this year, I've already lost half my money in crypto.
That's a good point. Crypto will beat out inflation any day when it comes to losing money or making money.
Actually, crypto didn't do too badly with the banks. Banks having issues, so we'll see. I still got a horse in the race with some crypto there. So hopefully that'll pick up a little bit. But that's our show. Any final words of wisdom?
No, maybe we'll do an episode where we talk a little about crypto. That hasn't been something we've talked about yet, has it?
I can't say I know too much about it, but I could always brush up on. We can get maybe Mauricio to come back and spout all the tokenization, pour the honey into our ears. All right. Well, we appreciate you guys sticking through this a little bit longer than normal episode. Hopefully everybody's happy tomorrow with the Fed's announcement. If not, we'll be back next week to talk about it. So make sure to tune in again next week.
Thanks, everybody.